Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about how to trade options in wild markets. Matt, do you want to share a screen and get us started by going over our current positions?
Sure. I don't know that we had any positions, but we have the old paper trading trade journal. And we could go back based on our entry time. A week ago was the 4th. So did we have one? Do we have a long call calendar?
Yes, I think we put something on last week.
Okay.
We were talking about macro events.
Right. So anyway, I do see that, let's see, it would have been March 4th, would have been at 219. I don't see anything in the paper trading. So we'll have to talk about it next time, because I don't see it in my trade journal.
Okay.
But there's a lot to get to today, Tyler. Obviously, the market's been going through quite a bit of turmoil.
Yes.
I'm an ancient guy, so I think I'm in a good position to talk about it. I used to talk to my grandfather, who was born in the 1800s, about he used to look at stock market. So I've been involved in it for a very long time as a market maker in the mid 90s, and then started ORATS early 2000s. So I've seen a lot of crashes and a lot of things happen. So I'd like to share some of my thoughts today, Tyler.
Great. Yeah, happy to hear. It was quite a crazy day yesterday.
Yeah, well, crazy day, and then crazy downturn. So let's look at it, kind of what's happening. So ever since Feb 20th, this is our outlook in our outlook tab in the dashboard. That's when the volatility started to rise past our dotted 10-day moving average of the 30-day implied volatility. And that's inversely correlated, so that's not usually a good sign, and we've been talking about that on some of the shows. And it's just continued to go down. People are realizing that Trump's going to art of the deal it and push markets and push trading partners until he gets what he wants. So it's going to be a little bit of carnage until then, I believe. And so you can see that volatility has been going up and up and up, and it's it looks like it's almost historically high. So, but we'll look at a longer term chart after this, and then we like to look at the SPY IV versus the components. Do you like that one, Tyler?
Yeah. So can you explain what that means a little bit more? The components of the SPY.
Yeah. So the S&P 500 is the ETF represented. And so the components of that ETF are 500 or approximately 500 stocks, and in various weightings. And so what you do is you can look at the weightings and multiply by, in this case, the implied volatility, in order to get a relationship to the SPY itself. And what that really shows is what I like to think of it as the benefits of diversification. So in finance, if you diversify between many stocks, you have a diverse portfolio, and theoretically you should get higher risk adjusted returns because the volatility will go down, but you'll still see the performance, the equity performance. Now, that's usually the case, and you could tell when you're getting a lot of benefit from diversification because the underlying ETF, in this case SPY, the volatility is much lower than the average absolute component weighted implied volatilities. So that's a good market. And a healthy market is when you get good diversification. An unhealthy market is when correlations, they say, go to 1, meaning everything just goes down at the same time and you get virtually no benefit from diversification. Does that analogy sound good, Tyler?
Yeah. So this chart then is comparing the diversified one against the non-diversified one, or?
Yeah. So it's all diversified. So you like to think that it's diversified, but it shows the benefit of diversification in good markets. So when you have kind of idiosyncratic, or when you have business risks happen, you could diversify those away. But macro risks you cannot. Meaning, so when everything moves and correlates together, that's a big macro risk. And what we're seeing now, and when you see this graph looking like this is not a healthy market. This is a market that is suffering from like overall systemic existential risks. So that's not a good thing for the market. So we've been saying that for the last couple of weeks, that this is an unhealthy looking market, and it's confirmed in the implied volatility going up, and not just the implied volatility going up, but the implied volatility versus the components going up. And then we also look at Contango. So Contango is that thing where the front month volatilities, the term structure, is higher than the back month. So this is called backwardation or negative Contango. We look at it as Contango because it's usually in a state of Contango where the front month volatilities are usually below the back month volatility. So this is August, this is April. So these are usually below, but what we're seeing now is kind of intensive negative Contango, and that's bad for the markets as well. So we're seeing a lot of confirmation in the markets, Tyler, meaning Contango is positively correlated to the market, and it's been going down with the market. Implied volatility is negatively correlated, and it's been going up while the market comes down. And then the relationship of the components to the implied is also negatively related. So we've been seeing a lot of very negative things for the markets. Now, the good news, if there is any, is that, and we'll talk about put call slope a little bit later. The good news is that it may look like it's getting stretched. So once you start seeing this come down, and once you start seeing implied volatility coming down, then that begins to look like maybe a bottom has been put in. So that's a good thing.
So this sort of confirmation that you're talking about, you're talking about confirmation that it's more of a macro event, like you were talking about the political challenges right now, or versus what's the alternative? Like what else could it be if the charts were saying something else?
Could it be meaning what is the problem with the market right now?
Yeah.
So yeah, it could be if for example, if we saw the market falling like it did back in January, and we really didn't see a big spike in the IV versus components. So that so that's probably something more in the potentially earnings, which I think led to some of this volatility, and then just some potentially more I guess diverse set of negative factors. But when you see the market behaving like this, volatility intensely high, volatility versus components intensely high, that's a pretty pure macro event happening. That's just going to, bring everything down. I mean, we've seen crypto come down. We've seen everything really except for gold. And gold eventually comes down because when people start liquidating. If this thing gets really bad, gold will come down too. So really the only asset class to have, I like to say, are puts in the market. So, as if you've listened here for a while, I'm a big fan of having protection. I do better in these types of markets. I still have, long positions on, meaning, I still have my kind of overall long-term positions. I have a permanent portfolio, which is 25%, in the market, 25% gold, 25% bonds, and 25% cash, some crypto. So that's my usual position that I have on to somewhere else. And then with options, I'm usually trying to protect those assets with a combination of put calendars or diagonals even. So in a very stable market, I use put diagonals where a diagonal is, in that case, on a calendar, way out of the money put calendar, and long term, you'll have the front month a little bit higher strike than the back month puts that you're short. So there's a little bit of actual risk there, but it's not really that risky because as the market goes down to the put calendar diagonal, the longer term will really increase in value. So just usually what I'll have is I'll buy like an $8 put and sell a $2 put. So there's still a lot of premium that I'm paying, but I'm selling a front month that has $2. So that kind of, in markets that kind of trending up, I don't lose a ton of money because, there's theta in the front, and you don't do that well, but you don't lose a lot. So that's the type of strategy I use in markets that are kind of uptrending, and very strong markets, like strong markets when we see when the benefits of diversification. So these are strong markets here when this ratio is falling, the ratio between the SPY and the components is falling, and so that's a case when I'm not that worried about the market, but I still always have put protection on. The second stage I go to is a straight put calendar. So it's a similar type of situation, but I might buy an $8 put and sell a $1 put. So the put isn't as aggressive, but it's still there. And then the next stage is a put spread. When I see the market starting to, there's some head fakes here, but like these are the times when I put a put spread on. These are these low times are the put diagonals. When it starts to get a little bit ugly, I'll put calendars on. When it starts to get even uglier, I'll put a put spread. And when it gets really ugly, sometimes I'll just buy straight puts. And we could talk about the timing later, but usually what I'll do is, in some of these events, the market, you'll see what's called a bear market rally, when the market just turns so quickly and rallies so fast that it's not really a sign of a bottom. It's a sign of like a short squeeze inside of a market that's falling. And sometimes then I'll even put on long out of the money puts at that time, because the volatility will come down, and and you'll have an ability to profit when the market, if there's a second leg down in the market. Obviously it's not very good if the market continues to go up, but that's usually not the sign of that. Does that make sense so far? I've said a few things.
It does. I think I noticed that the last thing you just described, I may have noticed it happening in Tesla this morning, because I was looking at it because it went down like 15 or 16% yesterday, and today it's up like I think 4%, but it's changing rapidly. But it feels like it might not be a sign of a reversal. It might be that sort of bear rally head fake you were talking about, where
Yeah,
maybe
I
some
mean,
investors are getting squeezed out of their positions.
yeah, Tesla got a double whammy. I think it has something to do with X getting, people are pissed at Elon and they're going after X. They'll probably go after Tesla. So, there's not only is there macro risk in the market, but Tesla has some of its own risks as well. So yeah,
Yeah, I mean, is there
yeah.
any indicators that we have that can help traders navigate these waters? Like, you're talking about good strategies to put on, which I think is good. But what about indicators? Is there anything from ORATS? Is there anything the options market can sort of give us a little bit more confidence in what we're doing here?
Yeah, I mean that's what we're getting into now. I mean, because what we're looking at is these implied volatility numbers, because eventually they'll come back down, and that's when markets tend to put in a base. So, but before we get too excited about that, I want to just zoom out and get some another look at things. I want to look at slope too. So this is our old school but longer term. So this goes all the way back to 2007. So right now we are here. And what you could tell from this market is, so this is volatility. This is implied volatility right here. And what you can tell from this market is that even though it seems like a big sell-off and everything, it's not. It could get a lot worse. So before you start getting complacent or whatever, we're not even to a normal correction. So I mean, this could get a lot worse. Meaning, you could see volatility spike. This is that August spike right here. Maybe I'll turn on my my
So
drawing.
why do you say it could get a lot worse? What indicator are you looking at there?
So, what I'm looking at, so this is implied volatility, right? So we were looking at the outlook tab where it looked like implied volatility was extremely high, right?
Mm-hmm.
But I'm here to tell you that this is not extremely high. This is extremely high. And this is kind of normal highs, like on good corrections, right? Like, so we're not even up to like a normal sell-off. So, to me, I think we're probably in the early stages potentially. It's hard to say because stocks turn around, and I've been talking to some friends that are bullish here. So I'm not bullish. I think it's, I'm still in my positions, but I have a lot of protection, and so I'm profiting from my puts. But what I'll probably do, because I think we're going to see something, like at least in this range, if we're going to have a good sell-off. And then, so this is a huge sell-off up here when the volatility gets in the 70s, and but this is like the mid 30s, and we're not even close to that right now. So that just kind of shows you, I think, some things to look for, when you start seeing these sell-offs. What might we see, and put it into some historical context. So, like, it doesn't even look like that big of a correction right now. And this is a lot, to me, what's going on right now is a lot more severe than some of the other kind of corrections that we had earlier. So, I expect, at least the volatility, before I'm getting bullish, I'm seeing volatility kind of near 30 instead of where it is now, near like in the 20s for SPY. So does that make sense?
It does. I mean, it reminds me of how people look at support and resistance for, price levels, right? Well, what you're kind of looking at is support and resistance for IV levels. Like, is it breaking through that, IV sort of, I guess, resistance, right, where you draw that horizontal line. And that's an interesting technique, like looking at some of these second order indicators. and sort of what those historical levels look like, because they look very different from the chart. Now, I was a little bit surprised to see that too. Like, you're right, IV does have a ways to go before it reaches those historically bad levels.
Yeah, I mean, so it's helpful to zoom out. It's helpful to have all this data, first of all. And it's helpful to zoom out and see, what could happen. And then, so it's, there's still like, I see these comments, is it too late to buy puts? For me, I mean, like, I have a bunch of puts. I've been getting out of some, but mostly I've like, when it looks like the market's going to turn, I'll buy a short-term call just to try to get that, that intense short squeeze bear market rally, I call it. But mostly I'm still into my put. I'm not closing these out, so I'm still, and I'm perfectly willing to see all the profits that I've got since it started coming down go away, because I still have my longs elsewhere, right? So, but right now, my puts have come, are getting closer to the money, and whereas I used to be long the market, now I'm kind of flat the market. So, I'm not, for me, I look at things like this and I say, well, yeah, if it comes back, I didn't monetize my hedge, it's called. So when you monetize, it just means selling out some of your puts or rolling them down or something. I'm not into that yet. Maybe I'll start when the vol gets up near 30, but I'll still have shorts, because it could, we could see that it could go to 70, in some of these, and you never know where it could go to. So, what I want to do this show is give people kind of some historical context, some feeling, if they didn't listen to us for the last 10 years, or if they didn't listen to us for the last year, and don't have any puts on, you could still dabble. You could still, if we get a market rally, I would say, I would buy some kind of pretty far out of the money puts. And I'm talking like, it could easily come down to, 5,000 or 500 on SPY. So you could get some cheap puts there and just put a couple on. I mean, not, then you kind of have some protection against, potentially your other, the other longs that you have on. And I should also mention, and I've only heard a few people talk about this, but most people are long the market even if they don't have stocks. Like, as the market goes up, the economy is better, people are hiring, a lot of good things happen when we have a good market. When we have a bad market, if these tariffs kick in, there could be some recession, there could be some contraction in hiring, there could be, housing prices could go down, everything could go down if that happens. So people, even though they might not be long the market, they are long the market. And so having puts is something that you could do to protect, especially in bad situations. So, if it starts going down 5,000, 400, 500, 400, there's going to be some implications in the market. So I think it's always good to have some puts. You could do put spreads that aren't that expensive. You could do butterflies that are even less expensive. They don't give you as much protection, but you want to make a little bit. You don't want to lose money if the market goes down. If you're already long it, you're just kind of, that's called a Texas hedge, buying a call and buying another call, so you don't want to be completely long the market. I think it always makes sense to have some insurance out there. We have insurance on our house, we have insurance on our car, we have insurance on our life. Why not have some insurance on the market, Tyler?
Yeah, it makes a lot of sense, Matt. I liked what you said about sort of people are long in their daily lives in the market, and I think you're right. I think most people don't realize how correlated their daily lives are to the market. So yeah, good points. And yeah, it's interesting just looking at the different indicators and seeing implied volatility is quite quite the indicator there, and you're right, it's got a lot more room to move. So I'm curious to see what happens there.
Yeah, definitely. So, I think we'll take this opportunity just to look at some of the scans that I used to that I put on in different times. Okay, so like, these put calendars, I think still might be something that you'll want to think about. IWM. So this is a put calendar, 400 and something days, 135 days, 10 delta. So it's way out of the money, right? And these are doing great right now, by the way. So, probably not the best time to put it on, but I just want to point this out. So, the market's 550. These are way out at 400, but but you're selling one. Let's just look at what they look like. So you're selling a July for $3. So that's a little bit higher than usual. Usually I'm, remember I said I buy an $8 and sell a $2. So now that front month is really jacked up. Yeah, you can see a 37 vol.
Yeah.
It's still it's still something that you're not going to lose a ton of money on, but you can make a lot of money. So especially if it goes down to here, implied volatility goes up. You're still making some good money on there. Now, if IV comes down, which it most likely will, then you're just getting to that amount that you paid, $541. But still, I think there's still time. Like if especially if we rally a bit, and you could get this for whatever, $5. But if you don't have anything, you might want to just spend the $500, get one of these, or however much that you want to protect. So you won't get this exact 10, but you'll get something along. You'll make a couple thousand off of this $500. So you want to maybe think about it that way. And again, the theta. If you look at theta right now, there is some theta that we're paying just because we have these $8. So the three doesn't really pay completely for that, because you still have a pretty strong option here, almost 3 times as high. So there's some negative decay when theta is positive. That's not good for you. You want negatives. You want it to come your way. Mm-hmm. So that's one thing to think about. That's that calendar. What I'll probably be doing when let me just see this long put. Yeah, so this is a backtested put, 16 delta. So this is going to be pretty expensive too. But if you look and you compare it to the strategy that we were just looking at, Tyler, you'll see the price is about the same, right? So but the strike is higher. There's not as much time, but these are things that I would think about putting on if there is a bear. Like if you don't have any protection, or even if you do. These will probably be the types of puts that I'll put on. Mm-hmm. So but I'll want to see the market rally back a little bit, instead of so now there's a 30 vol. So this 30 vol, you might say, well, Matt, I thought you said vol is 20. Well, these are out of the money, and there's a big skew right now. So, if you were to look at what are the 465s, if you were to look at right at the money at the 556s, that is a 21 vol. So that's a big skew that's on right now. Do you see that, Tyler?
Yeah.
So, if you're going out to the, well, let's now that there's some new ones here. So here's the 480 puts. This is a lot closer in. That's interesting. So this is a 32 vol. So I think if the market rallies a bit, you'll be able to get these for maybe in the high 20s, and that might be a better time. So that's what I would think of. That's what I would probably do when if the market rallies a bit. So for us for now, I think I'd rather do the conservative one now I'd rather I'd probably put on that calendar, Tyler. Just for us right now, until if the market rallies back a bit, then you could think about that put when the volatility comes down. So that's how I'd be playing things now. I mean, it's not easy. So again, what happens is markets tend to overshoot things. So they'll overshoot things on the way down. They've overshot things, I think, on the way up. So that what we might see is a big, if we do see a big correction, sometimes what you'll want to be watching is the volatility when that starts to turn. That and those outlook signals that we were looking at starts to go our way a little bit. That's when we could start to say we're not going to pick. We don't want to pick the very bottom, but we want to have our signals confirm it to us before we get long. So and when we get long, then you could buy like a deep in the money call or something. You could really get aggressive on that. But for now, I think we still potentially have a ways to go. So again, I'd like to look at that 10 delta calendar is probably one that I would put on now. So that 400. So that'll be the trade that we put on today, Tyler.
All right.
We'll force that. And that'll be our trade.
Nice. All right. Well, it's going to be an interesting week, so we'll see how this does. We'll see how this does next week.
Yeah, it is. It's interesting times. A lot could happen. Stay frosty, as people say, and don't over gamble at these times. You got to keep some of your powder dry. Anything could happen. So if you have some protection and you're a little bit long, you're already a little bit long, then I think you're good. Just don't get overextended. And good luck to everybody.
All right, thanks, Matt. Always lots to hear from you, and good advice, good notes. Appreciate you sharing all your wisdom on this show. Yeah, great to hear. So, all right, thank you, Trader, for hosting. Today we covered a lot about implied volatility, patterns in some of the ORATS indicators, and where sort of we think you guys can use protection on your portfolio in these crazy times. So thanks, Matt, for sharing. Thank you, Trader, for hosting, and we'll see you guys again next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.